Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 21st of March 2021. Today I'm going to be talking about fast money. Now look, this isn't a video about how to make a quick buck, sorry to disappoint you. It's actually about the velocity of money. The reason I'm talking about this is that, as you know, there are two schools of thought about how things will pan out. Huge deflation or huge inflation. And it's really important to be able to assess which of these is going to happen because, as my video on asset allocation showed, in deflation you want to be mainly positioned in bonds and cash, whereas in inflation, commodities and gold are the best places to be. I try to make a point of listening to both sides of the debate, and I try to work out the flaws in each side to try and decide which side I'm going to end up leaning towards. One of the common things I hear from the deflation camp is how low velocity of money means that we don't have significant inflation and how the velocity must increase for inflation to occur. And that just doesn't sit right with me somehow. So I thought, look, we really need to dig deeper on this and see if this argument has any merit. Now, throughout this discussion, when I say money, we all know that I mean currency. Okay, so the velocity of money is the rate at which money is exchanged in an economy. And as a correction to last week's video, it's the GDP divided by the money supply for a given time period. Now, to fully understand this, let's pick this apart further. Gross domestic product, or GDP, can be expressed in three different ways: value added, income, or spending. So to me, that means that GDP could be three different numbers, couldn't they? And the range could potentially be pretty large. So which one is being quoted? I've noticed that often it's just not stated, they just say GDP. My guess is it's going to be the spending version that's likely to be reported because it's going to give the biggest number. Now, within the spending category, we have consumer spending, business investment, government spending, and exports minus imports. Now, if we think about this, let's say consumers spent less, businesses used all their capital to buy back their stocks and didn't invest in growing their businesses. And governments went on an epic spending spree on rubbish, just to pay for committees and stuff that's not really needed. That would actually be measured as a large GDP. Seems to me that this metric can be fudged and isn't actually very meaningful. For the money supply side of the equation, what types of money supply do we mean? If we put it simply, M1 is cash, M2 is M1 plus short-term deposits, and MZM is financial assets with zero maturity. But does it make a difference which one we use to calculate the velocity? Well, more on that a little bit later. This chart provides a historical perspective of the velocity of money. Now, again, here it's not clear which type of money supply they've used here. They've just called it M. But we can see from this chart that the values have oscillated between about 1 and 2. And you can see that it was in a downturn from 1900 to 1946. Then it turned upwards, peaking in 1997, and it's been dropping since then. Right now, it's actually at a historical low. The next few charts go from 1960 to 2020. And here I've plotted the velocity of the three types of money supply. Shown in green here is the velocity of M1, and we can think of this as representing short-term consumption transactions on an everyday basis. You can see that this peaked over here in 2009 and then has plummeted since then. Shown in red is the velocity of MZM, and that gives us an idea of how often financial assets are switching hands. And we can see that this is much lower than the velocity of M1. How does this all relate to inflation? Well, we're classically told that to have inflation, we need the velocity of money to increase. But is that really true? Shown in blue here is the velocity of M1, and in red is the CPI, which, as we know, it's another fudge metric. Now, up until 1980, you can see that this relationship does seem to fit in with what we're told, and both are going up together. But this relationship seemed to have broken after the mid-1990s over here. So here the velocity is rising and inflation is relatively flat here. And again here, inflation is relatively stable here, but velocity has plummeted since 2009. Even if you use shadow stats figures for inflation, the relationship just doesn't work. What about M2? Well, interestingly, M2 velocity was pretty flat here throughout the 70s. And since the mid-90s, the velocity of M2 has been steadily dropping. This chart here confirms that there's actually zero relationship between the rate of inflation and the velocity of M2. Finally, we have NZM. Now, this does seem to have a reasonable relationship. So you can see both are rising here and both are falling here. But also notice here that this metric has been recently discontinued. I wonder why that is. An even closer relationship can be seen between the velocity of MZM and the 10-year Treasury yield. So the velocity is shown in red, the 10-year yield is shown in blue. So surely then, if the 10-year yield were to be suppressed, that would suggest that the velocity of MZM would also be suppressed, regardless of the rate of inflation. Now, this chart I found to be a real eye-opener. Shown in blue here is the inflation-adjusted S&P 500, and in orange is the velocity of M2. Now, I couldn't get the velocity of M1 or MZM on TradingView, but well, I think this is actually not too far off from the MZM as you would have seen in the previous charts. Now, the striking thing about this chart is the total divergence that occurs at this point over here. You can see they're moving in completely opposite directions. When is this time point? 2009. What happened in 2009? The start of QE. Is that a coincidence? Could it be that printed money went into financial assets rather than GDP, hence the drop in the velocity? To me, this chart depicts the effect of monetary stimulus. The printed money is siloed into financial assets, and I think that the effects of fiscal stimulus will actually be quite different. So when the government spends big using printed money and also gives it directly to the population, then you would think that that would be highly inflationary in the real world. But that still doesn't mean that the velocity will necessarily increase, because if we go back to our original formula, then that suggests that spending would have to increase at a faster pace than money printing in order for velocity to rise. I therefore don't think that it's a very useful metric to look at this. What about gold? Well, this chart shows that the M2 velocity has absolutely no relationship to the price of gold. In conclusion, I think that the velocity of money is a highly flawed metric that can be fudged and is misleading. When I'm listening to those on the deflation side of the debate, it's common for me to hear them bring up the topic of velocity of money. to support their argument. And I consider that to be a flaw in the debate. And also note that the velocity has no relationship to the price of gold. Look, this whole inflation-deflation debate is of great importance, and I don't have any particular incentives for being on one particular side of the debate. I just don't want to be crushed like an ant in all of this, and whatever happens, there are many that will be crushed. It's therefore important to try and work out for ourselves what's going on and to question what we're told by experts. Next up, the market update. Let's start with gold priced in US dollars on the daily scale. So what did I think of last week's price action? Yeah, it wasn't very impressive, was it? It was quite boring, actually. So what do we make of this? Well, I was hoping for a bit more of an impulsive upward move, and we haven't had that. And so this is somewhat concerning. But remember, in the big time scales, I'm still bullish, okay? So as long as we stay within this channel, which I consider to be a corrective channel, we're still okay. But that doesn't mean that there's not more downside to come. And there is potential to still hit the bottom of this channel a second time. But how likely is that? Well, one of the things that I noted was that price is moving up in this ascending wedge kind of pattern, and this can do any number of things. And so what we want to do is look out for where it's going to break out. If it breaks out below this line, it doesn't necessarily mean it's a disaster. It could have support over here at 1700 before changing direction and moving upwards. Or it could fall below that low, and there's potential there for about 1660-ish roughly, and that's the bottom of that channel, and that could still be bullish. But anything below this channel line, that's not going to be very nice. I don't think that's going to happen though. I'm still positive. But yeah, so there is the possibility of that, and so that's the level to watch. Of course, alternatively, price could just move upwards and break through this upper trend line and carry on. And the next kind of resistance level then would be just over the 1800. We do seem to have some resistance because of this trend line down here. And so that's another thing to watch. If we can break above that line there, again, that will be a positive thing. Do I think we're going to go up from here at the moment? It's hard to know, but I just got the feeling that we're going to have another little dip, but I think it's going to be small. I don't think it's going to be below this channel, as I said. Okay, now why do I say that? Well, one of the things that we look at is the bond yield. So this is the 10-year yield. And of course, if this gets too high, it's going to cause a lot of problems. But the question is, at which level would actions be taken to bring those yields back down? And you can see here, I've drawn this moving average here, which is the 100-month moving average. And this is the bond yields on a monthly scale going all the way back to 1981. So this is a nice long-term chart showing this bull market in the bonds. And you can see that whenever it gets close to that 100-month moving average, it kind of gets repelled. Here it actually broke through, but it didn't last for very long and came back down. And so we're looking for the bond yields could possibly go up again up to about the 2% level. I think if it goes higher than that, then that's going to cause a lot of problems, particularly in the stock market as well. And so that could possibly be a turning point where actions will be taken to try and bring them back down again. But hey, look, I don't know for sure. Will they come crashing back down to here? I'm doubtful actually, but yeah, as I said, I'm not a big expert on bonds particularly. I don't trade them and I don't particularly like them. It's basically debt, isn't it? And you're basically buying a piece of paper, which, as you know, I'm not keen on bits of paper or contracts and all that kind of stuff. But yeah, as you can see here, we've still got a little bit of room to get there. And so again, that fits in with the idea that gold might drop a little bit before turning around. But let's see. Let's move on to silver priced in US dollars, and this time we're on the daily scale. And we had this long-term trend line going back from March lows and joining this low here. And prices just been moving up and down either side of that line. It's quite interesting, isn't it? That line is kind of splitting that little wedge there. This 26 level does seem to be causing some overhead resistance issues there. And so what we're looking for is a potential dip below here. And how far can we drop? There's not much support until we get up to kind of the low 25 range over here. And potentially, yeah, it could drop below that, but I would expect to have reasonable support at 24.50 because of all of this over here. And at 24 as well would be pretty good. So those are the kinds of levels to look for. Of course, this could turn around and go straight up above, in which case we're looking for it to break this upper trend line. So we've got this narrow range to look at. But if we're expecting a slight dip in gold, then this could dip as well. But it's still bullish long term. Remember the big picture. So it depends on what your time scale is in terms of your investment or trading. Let's look at the GDX on the daily scale. And last week I had drawn a channel which was slightly different shape to this, and price actually broke out of that channel. But since then I've redrawn it, and this looks a little bit better because we've got many more touches to the trend lines on either side. So I think this is a little bit more reliable than what I'd drawn last week. And that's the thing with technical analysis, you've always got to keep adjusting. Don't just stick with one thing and think, yeah, that's it, that's set in stone. You've got to just change as things develop, as price action develops. And sometimes I completely clear all my lines and just have a fresh look at everything, because sometimes that can give you new insights. Okay, so we're moving up and down along this channel, which is actually quite nice. It's quite a gentle move upwards. The ideal thing is we want price to come above here, which is about 35.70, and then I think we're off to the races at that point. But I think we're still a little way away from that. So if we are expecting this to break out, I think looking at it, we've got a little triangle over here, haven't we, on the smaller time scales. And if it breaks out downwards, at least we're going to hit the height of this channel, which will bring us to around 32. And that's close to this red line here, which has been support for many years. So what kind of pattern could we be looking at here in this smaller area? I mean, one potential is that this could be a little shoulder. This is the head, and then maybe we'll develop another little shoulder here. So it might not drop as low as that. Or alternatively, this could be one bottom, and then we could be forming another bottom before making the move upwards. So those are the bullish scenarios that I'm talking about. If we break this low over here, then there is potential for a lot more downside, and we're looking at targets of about 24, but I'm not anticipating that happening still. So I'm still on the bullish side. And let's take another look at how the miners are performing relative to gold. So this is the HUI to gold ratio. And this red line up here is what we're looking for a massive bullish breakout for the miners. So above this, we'd expect the miners to consistently outperform gold. We've got 3 green candles in a row now. This is on the weekly scale, by the way. And this seems to be moving in this channel over here. This is quite positive that the miners are outperforming gold. And certainly when I look at some of my individual miners, I've had a couple that have actually broken out of their consolidation patterns to the upside. So that's encouraging. And I've got a couple that are right on the edge, but for those, there are little gaps just below, which again makes me think that price might dip a little bit before moving to the upside. And so with this we've got this channel, and what could happen here? Well, maybe it'll dip down and then come up and then start making its move. Let's see. We got to be hopeful. Okay, and then finally we've got the junior silver miners, SILJ, on the daily scale. And again, since August, we've been going through this long, painful consolidation. It's just up, down, up, down. Just looking at this kind of makes me feel a bit seasick. Anyway, this is the kind of pattern that can be quite frustrating. And it's basically sideways movement. We're not in a trending market. I would only consider bearishness if we drop below this trend line here, and so far no sign of that. Within the smaller time frames, you can see this upward sloping channel. So notice how gold, silver, and the GDX and the SILJ all have these kind of very tight patterns that we're looking at, and so we've got to watch that closely. Now here it's actually just poked below it to form a little wick, but then came back up. But I think it may well drop down a little bit, and again we could be looking at about 15-ish around here, or just below 15 if we look at the height of this channel here. So yeah, I think a little dip is possible, as with all the other indices that we've talked about. But I think if it does drop, I suspect we're going to get another turnaround to the upside. Now, maybe this will be like a corrective dip before making another similar channel to the upside. That's just one idea anyway. And what we would really love to see is a break above 18. That's what we're really looking for. This pattern is kind of squeezing closer and closer, and I think that when it does move, it's going to move quite big. The question is when it's going to make its move. This has been very, very long and frustrating for a lot of people, but that's its purpose. It's trying to frustrate people, trying to get people bored, so that when it does move, it takes only the strong hands with it. That's it from me for this week. Just one thing, I don't know if anyone can help me with this, but last week in the comments section, I had a few problems because in my notifications, some comments were coming up that I could read the first sentence of. But when I click on it, normally it allows you to read the whole comment, but this time whenever I click on it, it just disappears. And when I look in the back end, I can't see those comments anywhere. So it's kind of tantalizing. Some of them look really good, but they're not showing up. So I don't know what's going on there. I had a look in the held for review folder where they usually just put spam and other suspicious ones, but they're not there either. I don't know where they've gone, but yeah, if any of you have noticed that your comment hasn't shown up, that's why. I haven't blocked you. And you know, this has happened from some of our viewers that are regular commenters as well. So I don't know what's going on there, and I'm not quite sure how to fix it. So anyway, if that's happened to you, sorry, I don't know what to do. Anyway, that's all for today. All the best, and see you next week. Bye.